What if I told you that three stocks quietly went up over 300% while most people were busy chasing headlines and hype? No viral tweets, no loud TV debates, just a hidden pattern that smart money spotted early and almost everyone else missed. Stay with me because by the end of this video, you will never look at stock breakouts the same way again. Welcome back. If you are serious about understanding how real wealth is built in the stock market, not overnight, not with luck, but with repeatable patterns, you are in the right place. Today's video is not about hot tips. It's not about guessing the next meme stock. This is about a pattern that showed up again and again in three different stocks that went up more than 300%. And strangely, almost nobody talks about this pattern in a clear, simple way. Before we dive deeper, quick reminder, if you like calm, data-driven market stories like this, hit the like button. It helps the channel more than you think. And if you want more videos that focus on real market behavior, not noise, make sure you subscribe. All right, let's get into it. Most people think big stock moves come out of nowhere. One day, the stock is boring. The next day, it is everywhere. But that's not how the market really works. Behind every massive move, there is usually a long period of silence, a phase where nothing exciting seems to be happening. Prices move sideways, volumes dry up, retail investors lose interest. And that's exactly where this pattern begins. The three stocks we're talking about today come from different sectors, different stories, different headlines. Yet before their explosive runs, they all shared the same structure, not the same news, not the same products, the same behavior. Let me describe this pattern in simple terms. First, the stock goes through a painful phase. It drops hard, sometimes 50, 60, even 70% from its highs. Most people give up on it. Analysts downgrade it. Comment sections turn negative. Then something interesting happens. The stock stops falling.
Not rallying, not exciting, just not falling anymore. For months, sometimes longer, price moves in a tight range. Every rally gets sold. Every dip gets bought. To most people, this looks dead money. To smart money, this looks like preparation. Here is the uncomfortable truth. Most investors are addicted to movement. They want action. They want green candles. They want confirmation. This pattern offers none of that in the beginning. No excitement, no trending charts, no social media buzz. That is why it gets ignored. But markets reward patience, not excitement. Let's talk about the first stock. I will not reveal the name just yet. I want you to focus on the behavior, not the ticker. This company was written off after a major sell-off. Bad earnings, weak guidance, fear everywhere. The stock collapsed. Then, for nearly a year, nothing happened. Price stayed flat. Volume stayed low. News coverage disappeared. But under the surface, something changed. Institutions stopped selling. Insiders quietly started buying. Bad news stopped pushing the stock lower. That is a key signal most people ignore. When bad news no longer causes new lows, it means selling pressure is exhausted. Eventually, a small breakout happened. Nothing dramatic, just a clean move above a long resistance level. Most people ignored it. It did not look impressive. Then earnings came. Not amazing, just slightly better than expected. That was enough. The stock exploded. Over the next 18 months, it went up more than 300%, not because of hype, because of positioning. Here is the first big lesson. Big moves start when nobody cares anymore, when attention is gone.
When emotions are flat, when price feels boring, that is where risk is actually lower, not higher. Now let's look at the second stock. Different industry, different story, same setup. This stock went through a brutal downtrend. Retail investors were shaken out. Forums declared it dead. Then came the base. A long, boring base. For months, price stayed in a narrow zone. Volatility dropped. Volume dried up. This is where most people made the mistake. They assumed the stock was broken, but professionals saw stability. They saw accumulation. When the breakout finally came, it was fast. No time to think, no second chances. From the breakout point, the stock ran over 300% in less than 2 years. Again, no hype at the start. The hype came later. By the way, if this way of breaking down market behavior is helping you think more clearly, let me know by hitting like. It tells me to make more deep dive videos like this instead of surface level content. The third stock might surprise you the most, because even after the first 100% move, people still thought it was too late. They were wrong. This one followed the same pattern but on a bigger scale. Long decline, extended base, quiet accumulation, then a breakout that never really looked back. We will break this one down step by step in part 2, including the exact signals that showed the move was not over, even after it doubled. Here is why this video matters right now. Markets are shifting. Easy money trades are fading. Volatility is rising. Stock selection matters again. In environments like this, the biggest winners often come from places nobody's watching. The pattern we are discussing today isn't flashy, but it is repeatable. And once you see it, you cannot unsee it. In part 2, we are going to do something practical. I will show you how to spot this pattern early using simple price behavior. No complex indicators, no advanced math. And we will deep dive into the third stock that's shocked almost everyone. So make sure you are subscribed because you do not want to miss the next part. Take a moment and think. How many stocks have you ignored because they looked boring? That might be where the next 300% move is hiding. In part 1, we talked about something most investors hate: boring stocks, silent charts, no hype. Yet, those exact conditions created 300% plus winners. Now in part 2, we go deeper, because understanding the pattern is one thing. Spotting it early is where real money is made. Stay focused because this is the part where most people get confused and where smart investors gain an edge. Quick recap. All 3 stocks followed the same journey: a sharp fall, a long quiet base, selling pressure slowly disappeared, then a clean breakout that started a massive trend. This was not luck, this was structure. Now, the big question is simple. How do you recognize this pattern before the stock is already up 200%? The most important phase is the one nobody talks about enough: accumulation. This is the phase where big institutions slowly build positions without pushing price too high. They cannot buy all at once. If they do, price explodes early, so they buy patiently. What does that look like on a chart? Price moves sideways, sharp drops stop happening, every dip gets bought around the same levels. Volume stays quiet but spikes slightly on green days. This tells you something important. Someone with size is buying carefully. Retail investors are bored. Professionals are working. This signal is powerful, yet ignored. Bad news stops pushing the stock lower. Earnings come out, not great. The stock dips, then recovers quickly. Analyst downgrades appear. Price barely reacts. This means sellers are exhausted. When bad news fails, upside risk increases. This happened in all 3 stocks we are studying. Before their big runs, bad news simply lost its power. Most people focus only on fast moves. That is a mistake. This pattern is about time. The longer the base, the stronger the breakout. One of the stocks based for nearly 14 months. 14 months of boredom. But when it broke out, it never looked back. Time builds pressure. Pressure creates explosive moves. If a stock bases for weeks, the move may be small. If it bases for months, the move can be life-changing. Now, let's talk about the third stock. This one is important because even after it went up 100%, people still doubted it. The stock collapsed after a major trend ended. From the top, it lost more than 60%. Sentiment turned ugly. Then came the base. Not weeks, not months, almost 2 years. During this time, the stock looked completely useless, but something subtle was happening. Higher lows started to form. Each sell-off became smaller. Buyers were stepping in earlier every time. That is accumulation in action. When the breakout finally happened, it was not dramatic. No giant candle, no crazy volume, just a clean move above resistance. Most people ignored it. Then the stock doubled. At this point, fear kicked in. Too late. I missed it. It will crash now. But the pattern was still intact. The stock pulled back slightly, found support at the old resistance level, then continued higher. This is classic behavior of strong stocks. Old resistance becomes new support. So make sure you are subscribed and turn on notifications if you can, because part 3 might change how you approach the market forever. Now we reach the most important part. In part 1, you learned the hidden structure behind 300% moves. In part 2, you learned how to spot that structure early before hype shows up. In part 3, we connect everything. This is where most people finally say, now it makes sense. Stay till the end because this part is not just about past winners. It is about how you can think differently going forward. Let me be very clear. The power of this video is not the names of the stocks. It is the behavior they showed. Still, many of you ask for real examples, so let's talk clearly. All 3 stocks came from different spaces. One was a beaten-down tech name. One came from an old economy sector people ignored. One was a growth stock that everyone loved then hated. Different stories, same pattern. That alone should tell you something important. The market does not move on stories first. It moves on positioning. Here is a big myth. People think early buyers perfectly time the bottom. That is not true. Most smart investors do not buy the exact low. They buy after the stock proves it can survive. They wait for 3 things. The stock stops making new lows. Time passes without damage. Price starts respecting support. That is when risk drops. In all 3 cases, early buyers entered during the boring phase, not at the breakout and not at the bottom. They accepted patience instead of precision. That mindset matters. Here's something surprising. Even people who bought late still made money. Why? Because the trend was strong. When a stock truly enters a new cycle, it doesn't stop at 50 or 100%. Strong trends move in stages. Breakout, pullback, continuation, another pullback, another push. Each stage gives opportunities. The mistake most people make is emotional, not technical. They panic on pullbacks. They get greedy after big green days. The winners respected structure. Let's talk about mistakes because this is where learning happens. Mistake number 1, chasing after media attention. In all 3 stocks, news coverage increased after the stock was already up big. That is when risk was highest, not lowest. Mistake number 2, selling too early. Many investors sold after the first 50 or 100% gain because they were scared to lose profits. They ignored the bigger picture. Mistake number 3, over trading. Instead of holding strong positions, people kept jumping in and out, trying to be perfect. The market rewards discipline, not perfection. Now let's bring this to the present. Right now, there are dozens of stocks quietly doing the same thing. They are not trending on social media. They are not being pushed by influencers. They are not exciting. They are stabilizing. That is where you should be paying attention. Instead of asking what is hot today, ask what has survived the damage. This mindset alone puts you ahead of most people. Let me give you a simple framework you can remember. Step 1, look for stocks that had a major drop in the past. Step 2, check if the stock has stopped falling for several months. Step 3, watch how it reacts to bad news. Step 4, wait for a clean break above resistance or strong support holding. No rush, no pressure. This is not about catching every move. It is about catching the right moves. This is exactly why Stock Update exists. Not to predict tomorrow's price, not to sell false certainty, but to help you read the market calmly, logically, and without emotion. If you stay consistent with this approach, results follow over time. One last mindset shift I want you to take seriously. Big money is made by sitting, not clicking. Sitting through boredom, sitting through doubt, sitting through quiet periods. Most people fail because they confuse activity with progress. The market does not pay for effort, it pays for patience and timing. Think about this. The biggest moves in the market often begin when confidence is low, interest is gone, and silence is everywhere. That silence is not emptiness, it's preparation. Once you learn to respect that phase, the market starts to look very different. Now I want to hear from you. Have you ever sold a stock too early, only to watch it go much higher later? Or ignored a boring stock that later exploded? Share your experience in the comments. Your story might help someone else avoid the same mistake. If this three-part series gave you a new way to look at the market, share this video with one person who needs it. That small action helps the channel grow and keeps this content coming. Thank you for watching Stock Update. Stay patient, stay disciplined, and I will see you in the next video.